Hi everyone, welcome to ACCA Strategy Business Reporting. I'm in case I'm going to take you through the Strategic Business Reporting live sessions. Together we are going to push beyond boundaries. So we want to look at the main chapter, the group accounts or the consolidation. I'm pretty sure that most of you do have the background from the financial reporting. Yes, from financial reporting previously known as F7. So now when you are doing any strategic paper, I want you to know that it's not all about the number crunching. It's not all about the number crunching exercise. For you to pass the strategic business reporting, it's not just about calculations only. So you must even know how to explain. For example, you can be given a question where they say, can you explain how goodwill should be accounted in the financial statements? So you have to know your standards. It's about explaining, it's about application. So for example, when you look at the goodwill, you have to apply, when you look at the goodwill, the consolidation, you have to apply the IFRS number 3, the business combination. You have to apply IFRS 10, consolidation. You must know your standards. But today, what I want us to do is to do some calculations. Though I said it's not all about the number crunching, but when you are given a question, when they say including calculations, you must be able to calculate. You must be able to do the number crunching. So we do not know what the examiner is going to ask. So yes, we all know that group accounts are demanding in the exam, but we don't know what the examiner would set in your sitting. So that's why I want to do a full question, to prepare to do some working for you, to do a calculation for goodwill, a calculation for NCI, non-controlling interest, a calculation for the group retained earnings. Maybe in someone's exam, you can be given a question where they want you to explain how you calculate the goodwill. You can be given a question where they want you to explain how to calculate the group retained earnings, even the NCI. So it's better for me to do the full question so that anything that can be examined, you'll be able to answer. Right, so today I want to look at a question on test your understanding number 7. I'm using Kaplan textbook, so you can just even search. The name is Pepsi, right? So now on strategic business reporting, there might be a change in the group structure where, for example, we say the parent made an initial acquisition, then the parent might decide to purchase another share. So for example, let's say initially a certain company invested 40%, then later on you decided to add 20%. So that means initially if you acquired 40%, it means you have not yet gained the control, right? But if you add 20%, that means if it's now 60%, if it's now 60%, it means you've moved from 40% to 60. Look at this. Initially, you invested 40%. Later on, you invested 20%. So that means you now have what? 60%. So which is the acquisition date? When you invested 60% on this date, we say you now have the control. Okay, let's say this is 31st of December 2009. This is 31st of December, let's say this is 2019, let's say this is 2012. So which is the acquisition date? Acquisition date is the date that you gained control. So this will be our acquisition date. So this example, this is called non-control to control. Initially, you were the what? The associate. Then now, this is the company that invested. It's no longer called the associate. It's now called the subsidiary because we are now controlling it. So this is non-control to control. What about if we say initially invested 75%, then later on you decided to add 10%, 85% here, which is the acquisition date at this stage. This is your acquisition date because you already have the control. So this will be called from control to control. So the question that I want to look at is from control to control. Right. Text command, test your understanding 7, page 434. Okay, I know that the question wants us to discuss, but what I'm going to do is, on our session today, I want us to do all the calculations. Then we'll teach each other how to explain, how to discuss this additional investment in the disposal. Right. So I want to do the calculation. There is investment in Sprite, investment in Tango. So we have a financial position we are given. So allow me to do the working 1 to working 5. I'll start with the working 1 with my group structure. Working 1, the group structure. So Peps invested 1%. In Sprite, Peps invested 80%. So Peps invested 8% in Sprite. Then in Tango, Peps, they are telling us that Peps invested 75%. Then later on, there was an additional 8% in Sprite, meaning that it was now 88. Then later on in Tango, there was no step up acquisition, but it was a disposal of 10%. This would be what? This would be 65. Then W2, the net assets of subsidiary. The net assets of subsidiary. Oh, these are the subsidiaries. So I need the one for Sprite and for Tango. Okay. Sprite and Tango. I need the acquisition date and the reporting date, acquisition date and the reporting date. Now, what are we doing now when we prepare the net assets of subsidiary? We do want to value the company of the subsidiary. So, if you want to give a value, you look at the equity section because it is the parent, it is Peps that acquired this subsidiary. So we need to know the value of the Sprite at the date of acquisition and of Tango. So we have the ordinary shares and the retained earnings. Ordinary shares and the retained earnings. What is the amount? Remember, the financial position is prepared at the reporting date. So these are the amounts at the reporting date for Sprite and for Tango. 100 and 200 at the reporting date. Now we want the amounts at the acquisition date. So you have to read the information, the additional information. But on the ordinary share capital, just know that the capital doesn't change. So your capital is the same, is there. Then on the retained earnings, these are your profits. So the profits, they do change, right? So we need to read the question and see and look for the retained earnings at the date of acquisition. So they are telling us that Peps acquired 80% when Sprite retained earnings were 25,000. Sprite 25,000. Okay, allow me to put 3 zeros on the top. So 25,000, this will be 25 here. Then what about for Tango? When we invested 75%, we had the retained earnings of 16. So easy peasy. Then I'll sum up this using my secators. I'm getting 300, 160, 300. Now I need the post-acquisition profit. The post-acquisition profit. So from these dates, when we acquired the company had a value of 225. Then at the reporting date, the company now have a value of 300. So that means there was a gain of 75. Then when we acquired Tango had a value of 160. At the reporting date, it now had a value of 300. That means there was a gain of 140. So in Sprite, investment in Sprite, there's a profit of 75. That means the parent will take what? 80% of 75. Then on Tango, 75% of 140. Then the remainders will go to NCI. Easy. Then we move on from working 2 to working 3. W3. Now I need the goodwill. I need the goodwill of Sprite and the goodwill of Tango. So allow me to write W3A, the goodwill of Sprite. 300. What is our purchase consideration? Purchase consideration, the amount that you invested. Right. Remember, we want to calculate the goodwill at acquisition date. So you have to check the amount that you invested at acquisition at the date that you gained control. We gained control when we invested 80%. So I need that amount. So we paid how much? We paid 300 here at 80%. That's when you gained the control. Then the fair value of NCI at acquisition date, fair value of non-controlling interest at the date of acquisition, that's 65. Then less net assets of sub at the date of acquisition. We want to compare the amount that was paid by the parent versus the value of the company. So when we acquired Sprite at the value of 225, then the parent paid these amounts. So what is your goodwill at acquisition? The goodwill at acquisition, 365 less 225 to get the goodwill of 140. Do we have any impairment loss? On this question, we are not given the impairment losses. So allow me to end here. The goodwill at acquisition. So the purchase consideration that you take is the amount you paid when you invested the 80%. When you invested 80, because you had already gained the control. Because this is the goodwill at acquisition date. So at acquisition, we paid 300. So do not include the other 26,000. The 26,000, which is the additional investment, it's not on acquisition. That was on the reporting data. So then W3B, I now need the goodwill of Tango. I'm sure you've now mastered the concept. So the purchase consideration initially, how much did you pay? You paid 200. Then there is a value, the fair value of NCI at acquisition. The fair value of NCI at acquisition, that's 50. Right, that's 50. Then less net assets of subsidiary at the date of acquisition. When you acquired Tango had a value of 160. So the value of the company versus the amount that was paid. So 250 less 160, you get the 90. This is the goodwill at the date of acquisition. We don't have the amounts we don't have the impairment losses. So this is W3, the goodwill of Sprite and the goodwill of Tango. So because of space, allow me to to paste it here. Copy and paste. Goodwill of who? Sprite. We got 1/4. Tango. We got 90. Yes. Those are the amounts. Now, what we want, we now need to calculate the non-controlling interest. W4, the NCI. So, as you can see here, I'm starting with Sprite, then end it on Tango. Sprite. The fair value of NCI at the acquisition date is given there and is the same that we used when we calculated the goodwill. Right. So the fair value of NCI at the date of acquisition in Sprite, that's 65. So remember that parent invested 80% initially, and we said the remainder will go to NCI. So if parent invested 80%, that means on this profit we are going to give the parent 80% of this amount. Then the remainder of 20%, the remainder of this amount will go to NCI. This is the gain that was made. So the remainder, we have to add it here. The 20%, parent invested 80%. So the 20% will go to NCI. The 20%, that's 15. If you add 6, 7, 8, 8. Now this is what I want to look at, the step acquisition. Your NCI is going to change because there was an additional investment. Initially, you invested 80%, meaning that at acquisition, your NCI at acquisition was 20%. Later on, when you invested the additional 8%, it means your NCI was now 12%. So it shows that there is a decrease in NCI. So our NCI is 80. So it is expected to decrease. So allow me to reduce it. Decrease in NCI. It changed from 20% to 12%. So there is a change of 8 over what? 8 over 20, common sense. You multiply by 8 here. What do you get if you do the number crunching exercise on your adding machine? I'm pretty sure that you get something like, you get 32. So the NCI is decreasing, so you deduct. Then you get the balance of 48. Right. So, what's the common sense here? We are saying that the parent paid an additional of 8%. And there was a benefit that the NCI, when we talk about the NCI, we're talking about the amount that won't be attributed to the parent. So the parent is enjoying that. The NCI decreased by 32, but for the NCI to decrease, what was the amount that was paid by the parent for additional 8%? The parent paid an amount of 26. So I want to see if the parent made a gain or a loss on step acquisition. So allow me to do the W5, allow me to calculate the gain or loss on step acquisition. Gain or loss on step acquisition. Right. What was the amount paid? The amount paid was 26. The amount paid was 26 versus the decrease in NCI. There was a decrease in NCI, by 32. So if the NCI decreases, it means that the parent will benefit. It means that the parent will get more when it comes to sharing of profits. So the NCI decreased by 32, which is good for the parent. But for the NCI to decrease, it shows that the parent paid an amount of 26. This indicates that this is a gain. So this is a gain to the parent, the gain on step acquisition of 6. Right, because of space, allow me to paste it here, copy and paste. So gain on step acquisition of how much? Of 6. Right, the last working is for Tango. We now need the calculation for Tango W6. W6 NCI Tango. What was the balance? It's the date of acquisition. It shows that Tango had an NCI of 50. Then the post-acquisition profit, which is the percentage that will be attributed to the parent. Parent invested 75% initially, meaning that there is a remainder of 25%. So 25% of, we are now doing Tango of 140 goes to NCI. If I hit my calculator, I'm supposed to get 35. Then this will be 85. Now, there is a change. This one was not a step acquisition because it's a disposal. So initially, the NCI was 25%. Then later on, the NCI was now 35%. Was now 35% because the parent disposed 10%. So there is a decrease by 10%. So but the NCI has increased from 25 to 35%. So this is an increase. So our NCI is going to increase. Increase in NCI. Now when calculating increase in NCI, is totally different when you do the step acquisition calculation. Increase in NCI, it means the NCI has increased. So we want to take the amount somewhere. So you can't just say it has increased from 25 to 35. You can't just say 10 increase over 25. No, it's not a decrease. Increase, that means you are taking the amount somewhere. So the NCI is increased by 1%, the NCI is increased by 10%. Multiplied by what? Multiplied by the value of the company at the reporting data. Because the 10% was disposed at the reporting data. So you multiply by the value of the company. What's the value of the company? Those are your net assets. We do have the net assets of 300 here. So you take 300, those are your net assets. But you don't just take the 300 only because you are multiplying by the value of the company. So don't forget that goodwill is an intangible asset, so it's an asset too. So we have calculated the goodwill for Tango before and we got 90. So that means the value of the company now at the reporting date is not just the 300, it's the 300 plus the goodwill and intangible asset of 90. So the 90, that's for goodwill. So if you add 390 multiplied by 10, you get 39. So your NCI, you've increased from 85 to 124. From 85 to 124. Right, that's it, easy. Then we want to do the group retained earnings. Allow me to paste it here. Okay, before we look at this, we need to see if the parent made a gain or loss on disposal, right? So W7, gain or loss on disposal. On disposal, you cannot say the amount paid because you disposed. We want to compare the increase in NCI versus the amount that the parent received. So the amount received, parent received, they are telling us that parent received how much for selling 10%, sold for 35. So the parent received 35, then there was an increase in NCI of 39. So remember, parent will benefit more if the NCI decreases. So if the NCI is increasing, that's not the benefit to the parent. And so the parent disposed 10% and there is an increase in NCI of 39. Oh my God, but you only received 35. This shows that it's a loss. So there is a loss on disposal of 4. So allow me to paste it here. Loss on disposal of 4. Then what about the NCI balance? Our NCI balances for Tango is 124. Right. That's it. We now need the last working for the group retained earnings. What about the NCI balance of the NCI balance for Sprite? We calculated the NCI balance of Sprite and we got how much? For Sprite with a favor of 65 initially, and there was a post-acquisition profit. I forgot to paste it here. We had a post-acquisition profit of 20 or 75, and for Sprite that was 15. Then we had 18. Then remember what we did, there was a decrease in NCI by 32. So we got 48 last time, right? We got 48. So that means for NCI that's 48, right? Then the last working, that's the group retained earnings. We need to know the profit of the group. So W5, group retained earnings. What about the parent earnings? The parent earnings, we do have 391. Post-acquisition profit. So parent is getting a certain percentage from Sprite and another one from Tango. Initially invested 80%, then on Tango initially invested 75%. This of 140, this of 75. So 80% of 75, I'm getting 60. 75% of 140, I'm getting 105. So this is the post-action profit from the group. Then don't forget to include the gains or loss on step acquisition. There is a gain on step acquisition. I'm getting this gain from the working that we did previously, which is an amount of 6. Then there is a loss on disposal, which is 4, so I'm supposed to deduct in brackets. Then you sum up all those amounts. Right, for then on my adding machine, get something like 558. Right. So those are your workings. Then finally, you prepare your statement. So the left hand side has to equal the right hand side. So the consolidated statement of financial position for the group. Non-current assets, you start with the goodwill. So there is a goodwill of 140 from Sprite and a goodwill of 90 from, so I got this from W3A plus 90 from W3B. So 140 plus 90 is 230, 3 zeros on the top. Then if you look at the question, we have assets for the group. This is 1,000 for Sprite, for Pepsi, 800 for Sprite and 500. So you just get 1.8 plus 500, 2.3. Do we have the current assets? We are not given the current assets, so you just sum up. So 2.3 plus 230, 2320. These are my total assets. The left hand side just to equal the right hand side. Now we need the equity and liabilities. You start with your equity, ordinary share capital. Your share capital, I'm only taking the amount for the parent, which is 500. You can't take for the subsidiaries because we have already included that in W2. Then what I want is the retained earnings. We are on equity. Remember, retained earnings we got from working 5. So this is not working 5. This is supposed to be working number 8. So this is 558. Then don't forget to include your NCI. The NCI, we got 48 from Sprite, then we got 124 from Tango. So 48 plus 124, 172. So when you are doing strategic business reporting, don't spend much time on calculations. So because I told you that it is not all about the number crunching, it's about knowing even how to discuss in the exam. The reason I'm taking time is because I'm explaining. Then lastly, we have liabilities. Liabilities, 100 plus 200, this is 300. Then we also have the ordinary shares, the retained earnings, the non-controlling interests. Right. What else is left? So the liabilities is 600 plus 500. This is 600 plus 500 plus 200. This must agree because if you do the right thing, it has to agree. 1.3. I'm getting 2530 here. Then from there 230 plus 2.3, this is 2530 again. So this shows that the left hand side equals the right hand side. So time is of an essence in the SBR exam. So you need time to manage your time, good speed and good success. Okay, thank you very much for your time. See you in the next lesson.